From war across the globe to regulating speech to printing trillions of dollars, the American regime accepts no limits on its power. As Ludwig von Mises understood, the state will take as much power as the people will let it. And in recent years, the American regime has clearly concluded it can get away with unilaterally adopting vast new powers. Join Michael Rechtenwald, Ted Galen Carpenter, Jonathan Newman, and more for a Mises Institute event in Nashville, Tennessee on September 23rd, dedicated to this siege of power and one of Ron Paul's favorite lines, "Truth is treason in the empire of lies." Tickets begin at $95. Use code HA23 for $45 off admission. Get yours at Mises.org/Nashville23. This is the Human Action Podcast, where we debunk the economic, political, and even cultural myths of the days. Here's your host, Dr. Bob Murphy.
Okay, well, Peter, welcome to the Human Action Podcast.
Hi, Robert. Thank you for having me. Good to see you again.
Nice to see you. Someone had asked, they said, if hey, Bob, if you're bringing on a new person, can you explain a little of the background? So maybe in lieu of me doing it, can you just explain just a little bit of your background for the listeners before we dive into your book, which is going to be the main topic of our discussion?
Okay, well, I was born and grew up in Johannesburg, South Africa, which explains my East Texas accent. And I then went to the University of Chicago to get my PhD. And I was very lucky that I managed to work with Gary Becker on the economics of discrimination, having come from South Africa. So a kind of a fortuitous coincidence. After Chicago, I went back to South Africa for 3 years and then came to Dallas, and I've lived in Dallas ever since. I've spent most of my life living in Dallas. I teach economics in the School of Management at the University of Texas in Dallas.
Okay, great. So the issue that I want to talk to you about today is your relatively recent book, Capital and Finance, that you have with your co-author Nicolás Cachanosky.
Cachanosky, yeah.
Okay, and so I know there's a story behind it. So I think it's interesting that you tell in the introduction as to how it began. So do I have it right that Nicolás contacted you and said, "I think I have a solution to how do we use Bohm-Bawerk's average period of production formula, or the way to use it properly?"
Yes. So, Bob, should I assume that your audience will understand?
No, that's what I was going to say. Right. I was going to say, before we dive into what the solution is, can we first explain like the historical context and like what the ostensible problem was? Because I know, according to Paul Samuelson and guys like that, and in a history of thought, Mark Blogg's History of Thought, he said that the whole re-switching debate was the final nail in the coffin to Austrian capital theory.
Yeah.
And so I think it probably would help people, if we spent just a minute or two given the historical background and then explain what, so they'll understand your solution.
Yeah, okay. I'll try. It's a little wonkish, that's the problem. Yeah, but I mean, the Mises...
Wonky's okay, just as long as the crowd wants to hear it and they're intelligent, but they might not just know the context. So
the context,
as long as you don't assume anything, it should be fine.
Okay. So I basically grew up in economics studying capital theory. Also, one of those fortuitous circumstances in South Africa when I studied economics and history, my teacher was Ludwig Lachmann, and his speciality was because he had studied with Hayek and at the London School of Economics. So he kind of got into capital theory, and his sort of seminal work, other than methodology, was capital theory. And I didn't even know what I was doing, but I sort of got very knowledgeable about it. And so a lot of my early work was on Austrian capital theory. Austrian capital theory was the theory for which the Austrian school at one time, late 19th century, and then into the first decades of the 20th century, was well known. It was also a sort of, at the time, featured in analysis of Marxist theory and sort of Marxist basic idea that capital doesn't produce anything and therefore should not earn anything, so to speak, exploitation of labor and so on. So the prime theorist at the time, at the end of the 19th century, was Eugen von Bohm-Bawerk, who was a student of Menger's, also a well-known finance minister of Austria, wrote 3 volumes on capital and interest. And a central feature of his work was the observation that productivity, the attainment of prosperity, came about through ever more complex methods of production, what he called them more roundabout methods of production. And then he sort of went down a rabbit hole into trying to explain what he meant by more roundabout. And looking at it in retrospect, it was perhaps unfortunate, but he kind of stumbled into a physical measurement of roundabout methods of production, of roundaboutness, something. And it turns out that measure, which he called the average period of production, was actually very close to the kinds of things that Bohm-Bawerk was himself criticizing. And also, of course, when I was a student of Lachmann spent a long time on the average period of production and explaining why it was an untenable concept. Basically, what Bohm-Bawerk tried to do was to reduce sort of the capital contained in any project to dated labor hours. And as one might realize, that gets close to adopting a labor theory of value sort of thing. And he also...
Can I stop you maybe for a second, Peter?
Sure.
Let me just, for the listeners, just everything you're saying is great, but like to give them just a quick example. I like the one, I don't know if I invented this or Bohm-Bawerk did it himself, but like a guy's out in the woods and he's trying to get water from the stream, like to his cabin or something, in a very direct, immediate way, is just going back and forth, cupping the water in his hands.
Right.
And that's a very immediate production process to get water from, the stream to his cabin.
Right.
But it's very unproductive. And so instead, if he first goes and gets a coconut and hollows it out and then goes and uses that like as a bowl,
yeah,
and then goes back and forth, that would be more productive. But the first water doesn't hit until, some length into the process, delay.
It takes time. That's the key. Yeah. Thank you for... Yeah,
and then you can imagine longer term things about like digging a trench and so forth and building pipes. But so it's like congealed labor in the capital goods. That's kind of the idea.
Right. And we must emphasize that he was trying to measure time. He really wasn't, in a sense, trying to measure capital, but he was trying to measure time, but sort of a time measure of capital. Perhaps another example, maybe better example, is Robinson Crusoe on a desert island. He catches fish with a spear in his hands. And then one day it occurs to him to build a net. But it's very time consuming to build a net. He takes the materials that he has and in the meantime he could die because he has to eat while he's building the net. So he has to save up stuff, food, berries, whatever it is, dried fish, so that he while he's building his net, he can still eat. That metaphor sort of captures a whole lot of stuff about capital theory, the subsistence fund, time, etc., etc. Anyway, so Bohm-Bawerk has this measure of time, and his critics jump all over him because they say it's contradictory, it's incoherent, capital is heterogeneous. Lachmann pointed out you can't really compare the different forms of labor that are in there, and what it's. We don't have time to go into that in detail. Suffice it to say that the Austrians pretty much agreed that the concept average period of production was not theoretically consistent. It wasn't theoretically bulletproof. Nevertheless, they wanted to embrace it. They wanted to be able to say that certain kinds of productive processes take more time, are more indirect than others, because that was an important feature in the Austrian business cycle theory. Because in the Austrian business cycle theory, when the the government in an expanded credit policy reduces interest rates, that biases investment towards longer term or more roundabout methods of production, and then capital gets misallocated by that process, which is unsustainable and is bound to become unstuck, and you get a business cycle. So for many years, decades, the Austrians labored with a measure or a reference to this kind of idea of longer periods of production without really having any kind of theoretical concept that captures that idea. I remember debating this with Roger Garrison, for example, a key developer of what we might call Austrian macroeconomics. And he said, well, yeah, it's sort of the entrepreneur's subjective view of projects that appear to take more time. Actually, that's more sort of insightful than I realized at the time.
Mm-hmm.
And then we have more recently, young Austrian theorists working on empirical work, and they now need to sort of test the Austrian business cycle theory, and they go out and they adopt some kind of like Hayek stages of production measure and various. It just sort of missed the mark, so to speak, in terms of being completely consistent. So then, shall I go on to?
So let me so I get like big picture. When you would read Bohm-Bawerk talking about specific example, illustrative things like Robinson Crusoe, and you could understand, Robinson Crusoe, if you give him 5 years and he can go grab things, build nets and build boats and spears and he's in a better spot. And then you understand why his labor's more productive, why he has a higher standard of living.
Right.
If he first has 5 years to accumulate capital goods, when really ultimately he's just starting out with nature in his bare hands.
Right.
And so, like, to understand why are some countries richer than other countries and have a higher, and they're more capitalistic, and they've over the decades they've invested more of their labor hours into longer term so you want to be able to say things like that, but your point was the specific metric that he used, the formula for here's how you calculate that. There were serious problems with it, and so it was kind of like, we want this to work, but we can't quite make it work.
Right. Exactly. And we should emphasize it's not time. It's not the fact that it takes more time that makes it more productive. It is that if you see a project that or strongly suspect will be more productive, if it took less time, you'd already be doing it. So basically, it's wisely chosen more roundabout methods of production, successful ones. Robinson Crusoe could labor mightily and then fail. But if he succeeds, then he will be more productive. So that's sort of a metaphor for how countries manage to reach prosperity is because they sort of trial and error of different projects, and over time the production structure becomes more complex. But we can't exactly point out sort of that time metric. So I made a habit of communicating with graduate students when I went to the annual conference where Austrian economics was featured, the Southern Economic Association.
Mm-hmm.
We had panels there, and I tried to, communicate with some of the graduate students to find out what was going on and what they were working on. And so I knew Nicolás Cachanosky. He was busy on his PhD. My good friend Steve Borwitz was involved in his dissertation, I think, and we met on a few occasions, the three of us and me with Nicolás. And then one day I got a paper from Nicolás, and it from the title it was something about the average period of production and a new measure. And I looked at this, and over the years I'd had so many papers about that and spoke to so many people, and I just another one. To be quite honest, I've told him this. I was kind of reluctant to read it, wondering if it was worth my time. But because I knew Nicolás, is really the only reason I did. I started reading it, and the more I got into it, I thought, wait a minute, this can't be right. And so I got hold of a pencil. Well, I was doing it online, so I start editing the paper, right? And I go back to the beginning because I say I have to give more attention to this. And by the time I finished it, I'd completely marked up the thing. And I was like, this may be right. And I sent it back to him and I said, I'm sorry, I've edited the whole thing. Can we talk about it? You don't have to accept my edits. 10 minutes later, an email. Do you want to be a co-author? So that's the beginning of this project. And as it turns out, I couldn't have foreseen at the time the implications of what we had found, specifically really what Nicolás found. And then I saw some other implications and we put this work together. It's actually an astounding, I think we've written a very important book, and I think we've done some very important work, and I don't think it is yet fully appreciated, partly because capital theory is not as central to what Austrians do anymore. Pete Leeson famously said, advice to young Austrians, God, do not write another article on capital theory. So anyway, that's the background story.
Right, and I viewed Leeson's comment as a microaggression on my own work. So let me, and just, I'm not merely engaging in flattery here. That's partly why I didn't want you on the show, and because you're right, I agree. Your book, when I saw that, I said, oh yeah, this is important stuff to give the folks at home some context. For years now, when young people who are interested, like going into grad school, they love Austrian economics, but they need a dissertation topic. And I have been saying, do something that intersects with like financial economics or just, corporate finance, something like that, because I'm telling you, and there's various reasons for it. Like at a theoretical level, they don't assume general equilibrium. Like they have a no arbitrage assumption, but that's just kind of like, the entrepreneurs got rid of all the pure profit opportunities. That's kind of okay. But they don't have this long run static, everything's repeating itself idea that you do get in some sort of macro models. And just taught, when I give presentations talking about the Federal Reserve or something to people in the financial sector, they get it right away. Like I don't call it Austrian business cycle theory, but that's what I'm showing them. And it's very intuitive to them. They don't have all the problems that like academic economists have with that stuff. So that was kind of my, giving them advice. Like, here's something, if you don't want to just do like a history of thought dissertation or something, that if you want to do something that seems like it has implications especially after the 2008 crisis, like, hey, this is even hot stuff, money and banking, that's all in the Austrian wheelhouse, actually. So when I saw, when I knew that you and Nicolás had been working on this, you had so many co-authored papers, I would tell people, go look at what they're doing. I think that's the kind of, if it interests you, you can get a job writing on this stuff too. Like people actually care who don't just like Austrian economics. So I agree with you. This is a relevant, fertile field that is directly tied to Austrian economics. Like you're not just trying to be cool or relevant. Like this is legit Austrian stuff that has implications for what other economists are working on right now.
Absolutely. And in fact, we didn't realize how much at the time. And now that you mentioned it, I do remember some of your work on interest rates and how it ties to financial stuff. And Nicolás,
I don't know if you remember this, but your story about Nicolás was somewhat similar because you, for the Society of the Development of Austrian Economics, a long time, like this is 2001 or something, you were like the reviewer of my paper that was submitted. And you got up and you said something like, when I first saw this, and I was like, who is this Robert Murphy bringing up the dead horse of Mises? And I was prepared to do a number on him. And then I started reading. I was like, oh, actually, he's making sense. So it was a similar thing. Apparently, like you thought you were going to trash my article too. So anyway,
I didn't know who you were.
No, hey, fair enough.
No, so, I remember that very well because I was incredibly impressed with that paper.
Well, thank you. That's I always liked you. Okay, so we've kind of let the people hang in suspense here for a bit.
Yeah.
What is the solution? What was in Nicolás's original paper to you that you guys then hammered out and perfected that solves that is this unicorn?
Yeah. Okay. So it's interesting. The solution was hiding in plain sight, as it turns out. Bohm-Bawerk uses a kind of a labor approach. It's a physical approach, right? Mm-hmm. He's kind of looking at there's always the question of, in what sense is it more productive? Does it produce more things or does it produce more value or both? And thinking about it sort of, again, in retrospect, it doesn't matter if it produces more things. People aren't concerned so much with that. they're concerned with it because they have the more things. But really, somebody investing in it is concerned about the value of the project. In a monetary economy, that's what you're concerned with. And basically, Hicks, who was always been very sympathetic to Austrian economics in his own way, he kind of had this double identity or triple identity, as it were. It was very eclectic. And, and I think he read German and understood it. And he understood the Austrians. He sympathized with the Austrians. He admired Hayek, but he also was a fantastic mathematician. Well, not mathematician, but applying mathematics to economics. And also he was hung up on equilibrium for some reason. He didn't do much if he would have just, anyway, that's another whole story. But it turns out he writes the seminal work published in 1939, Value and Capital. And in Value and I remember reading it, and it kind of just passed me by. He talks about Bohm-Bawerk's work because Value and Capital, right? It's only one of three books that Hicks wrote, each of which had capital in the title. And there he says Bohm-Bawerk has this average period of production. He measures sort of time in the form of physical inputs. But if only he would have used value inputs, he could have got a consistent measure. And he says something like, I think this is what the Austrians are looking for. This is in 1939. He repeats it, but in more briefly in his two subsequent books, in Capital and Growth, and then in Capital and Time, and nobody takes notice of it. Hayek publishes his Pure Theory of Capital in 1941, and this was published. Hicks was published in 1939. All Hayek's articles through the 1930s on capital, and Hayek is wrestling mightily in 1941 with the admission that the average period of production is non-viable. And so he's got all kinds of alternatives, almost embarrassing in a way. So what Nicolás did, he said, he didn't know it at the time, but he found this concept that Hicks had independently through Macaulay's duration. Macaulay founded in 1938, Hicks in 1939 independently. And what it is, it's to try and explain. Your audience may understand the idea of a discounted cash flow. Okay, so there's the connection with finance. Any investor has a business plan, and they figure to earn a certain flow of earnings over time. They figure to spend a certain flow of expenses over time, and the net between them will occur over time. That will be their expected profits. But something earned 10 years from now is not as valuable as something earned today. So we know very well about the time value of money and how to basically reduce a future cash flow of income, because it's a flow, right? It's you've got a stock investment, and then that gives rise to a flow, and you've got ongoing investments actually over time. And you want to reduce it. If you want to reduce it to one number, you can do that by saying, well, how much would you pay for the business if it yielded this flow of profits today? Or another way of doing it, if you invested this much today, at what rate would it have to accumulate to give you the equivalent flow? Now, if you use the present value, the net present value, what we call the capital value, that of the business or of the project, as the value of the project, and then you calculate how much value is going to be earned in each time period, and you use those weights, the proportion that is earned in any particular time period, as a weight for the amount of time that you have to wait. I'm using, it's a little confusing, weight and weight. Okay.
Right.
So we, instead of using physical weights like labor weights like Bohm-Bawerk used, you use value weights. Let's say that it's an unusual project and it only has 3 periods. And in each period, 1/3 of the entire cash flow is going to be earned. So then whatever is earned in the first period, you have to wait 1 period for that, is weighted by 1/3. The second period, you have to wait 2 periods. That's going to be weighted by 2/3. So in other words, time, the significance of time is captured by how much value is earned in that time. And if you use that, you can. This is where showing a picture might help. You can see what you get is a weighted average of the time that you have to wait to earn $1. So it's the average amount of time that an investor would have to wait to earn $1. How long do you have to wait on average to earn your particular cash flow? It's exactly the average period of production, or you could say the average period of earnings.
Mm-hmm.
And it's subjective, of course. It's a judgment. The entrepreneur because the future is uncertain, the entrepreneur has to have in his or her mind some kind of business plan about what's going to be earned and when, what's going to be earned and when. And it's looking forward. A lot of what Bohm-Bawerk did, he sort of smuggled in the assumption of equilibrium, so that it will enable him to look at a particular capital project and look at the capital involved in that and see how long it took looking back to produce that on average. And then if you're in equilibrium, that's going to be repeated in each time period. And so he's using a backward-looking measure of the average period of production, which just added to the confusion. In this case, if you use this concept, which is called in finance duration, sometimes Macaulay duration, variance modified duration, it's well known in finance. It is also, as it turns out, that Hicks pointed out, wheels within wheels, that this concept of duration is actually the interest elasticity of present value. It's actually the discount factor elasticity of present value. So if I is the discount rate, then 1 plus I is the discount factor. So if 1 plus I changes by 1%, the duration at that point, in measuring the duration, will tell you by how much the capital value will change. So this gives an actual concrete measure to the idea that if somehow the central bank manages to reduce interest rates, and particularly reduce the discount rate that the investor is using to decide on a particular investment, it tells you by how much if the investor believes that that's a lower interest rate, it tells you by how much that investor will regard that particular capital project as more favorable than it was at a higher interest rate. And it shows you this bias. You can actually quantify it in a sort of a formal way. It shows you how much this bias works towards longer lived projects that take a longer time to yield their earnings to you. So,
and maybe just to give a quick example for people, for them to relate to something they might know in a different context. So like a firm or like a bank that owns a bunch of bonds, like I know recently, like when SVB went down,
yes,
people were worried. So, the problem is the Fed raised rates, and so the people who were sitting on bonds, their market value dropped. And then, of course, as people understood, the longer the term of the bond that you held, the bigger effect that would be. So if you're just sitting on T-bills, rolling them over, rates rising isn't as big a deal as if you're sitting on 30-year bonds and then rates all across the yield curve shift upward. And duration is, the way to say, what's the duration on that guy's portfolio? What's the one on that, and so people understand that, changes in interest rates affect the market value of fixed income assets. And this is kind of what you're saying, like in the Austrian capital view, it's like physical capital goods are like technological claims on future cash flows, as opposed to a piece of paper.
Well, I'm glad you brought that up, because actually, I use that example. Of course, when we wrote the book, that wasn't something we could use. Mm-hmm. But it became clear, of course, that duration is not something what Hicks called the average period, and this duration measure. Mm-hmm. It's not something you can measure. If we want to do empirical work, it's not something you can measure when you're dealing with physical capital, physical production.
Right.
You can, I mean, things like houses, there's an obvious, but you don't really, because what is a house? A house is a stock of household services, so to speak. But each investor is going to have their own particular expectation of what the asset is going to earn, and as well as their own particular discount rate. Now, when it comes to fixed income assets, financial assets, we have a situation where the cash flow is known if we abstract from default risk.
Right.
So then you know that you know what that asset is worth today if you use a common discount rate. And in a way, the Austrians, maybe in retrospect, it seems as though the Austrians been selling their story short, because as you say, the Austrian business cycle thinking is very, very intuitive. I mean, in a sense, it's almost undeniable. I'll put it another way. Austrian business cycle elements appear to be present in so many different business cycles. It's not always the same story. But what you're getting is interest rates are changing the capital value of different assets, physical and financial, across the economy in a particular way that pushes it towards longer assets, longer term investments. And the case of Silicon Valley Bank and similar cases is crystal clear. I mean, the question immediately becomes, why on earth did they invest so much in these long-term assets? They must have known that any reduction in interest rates that's going to come about when the Fed decides to change course is going to wallop the market value of those financial assets. The proportional change, it's not just so if something is, takes twice as long, it has twice the effect. It's more than that. It's exponential. Because the longer you have to wait, those weights, are heavier towards the further end, if you like, of the investment. So, I mean, the value of those things was really bashed. And the nice question is, why did they do it? And then there's the whole question of what they were expecting the Fed to do, and how the Fed had sort of denuded other possible investments for commercial banks at the time. And it really opens the door to a very interesting discussion, not only of sort of what causes these kinds of mini cycles or bigger cycles, but also what the implications are. And so I think this is as you point out, this is a connection from capital theory to finance that it should have had, and accounting. So if I may, I'll tell you interesting with regard to sort of also the history of economic thought that came up in the course of our.
I want you to, yes, but can I just say one thing here?
Yes, please.
Fast? Because I noticed the connection going both ways, that the Austrians be sort of single-mindedly focused on the physical capital goods were missing, like you say, some of these obvious insights from finance. But on the other hand, too, when I was trying to get a job on Wall Street and I was reading up on all the, even the people that were writing like treatises at like Fisher Black and stuff, talking about interest rate movements and the models they had, it was all like assume a random walk and blah, blah, blah. Like they didn't know where the interest rates came from. Like there was no capital structure. So that's why I thought there's this middle gap here where an Austrian could jump in and kind of connect these two worlds.
Absolutely. Absolutely. Which is one of the reasons why we hope that, Nicolás is still young, but I'm hoping that have people who are younger than I am, have more energy, will take this and run with it. Absolutely.
Okay. So, but I interrupt you. We're going to talk about the history of thought.
Well, the interesting thing is, so we start looking at this and as we get more, I was giving a paper on it in the early stages at New York University in their colloquium with Mario Rizzo. And I'm presenting this, and then Mario stops me and he says, do I get this right? Are you saying that all that controversy, the three capital controversies, and by the way, we do also address the re-switching debate and show how that's nonsense, that he says, do I have it right that these controversies were all unnecessary? And that took me a little bit by surprise, because, I have never been one to sort of overestimate my insight. And there's a little bit of chutzpah involved in making that claim. But essentially, it's true.
Mm-hmm.
That controversy seems, in retrospect, maybe to not have been necessary, which it still shocks me to imagine that. But otherwise, why on earth did Hayek not even address what Hicks said? You know, the only explanation is they missed it. Nowhere do Lachman, at one point, he's talking about sort of what we can say about capital and how we can measure it and all that. And he says, of course, it is true that each entrepreneur engages in a discounted cash flow analysis. He uses words almost to that effect.
Mm-hmm.
He says, but this is not saying much, and dismisses it. I mean, I didn't notice it when I read it the first time.
Mm-hmm.
And Hayek surely knew this.
Right.
Nowhere in the Austrian liturgy is there any sort of discussion about the discounting of future cash flows and getting sort of a present value. But the interesting thing that we as we began to look at this in more detail, Mises never entered into a capital controversy question. Mises never wrote a book on capital.
Right.
Persner wrote a book on capital. Lachman wrote a book on capital. Hayek wrote so much on capital. Mises wrote a lot on capital, but he never sort of isolated. So we went back to Mises, and we find a definition of capital in Mises. Mises defines capital as the money equivalent of the difference between the assets and liabilities of a particular business or a particular venture. The money equivalent.
Mm-hmm.
If you look at the article, look at the book, you'll see that that definition. Nobody stops there. And he's talking about assets and liabilities. He's using accounting concepts.
Yep.
He never gets quite there. But Mises it's very clear in Mises, astoundingly, that for him, capital is value. It's not physical things. It's value. And there are other examples, because at one point, Mises says, it's very important to distinguish between capital and capital goods. And it would have been better if the term capital goods had never been invented, and if instead they just talked about productive resources. So for Austrians, that ought to be noteworthy.
On that point, Peter, I gave a presentation. I don't know if you were there or not. It was when I was at Texas Tech, and the title was, I know David Henderson was there, and he came up. The title was something like, capital goods and financial capital are different things, or something like that. And it was just a whole, me just going through it and just showing, starting out with real obvious stuff. And like, oh, yeah. But then going through and just showing a lot of these controversies and things, like it's people using the same word capital, but mid-argument, they flip from the one meaning to the other, and then they end up with some crazy, it's like, no, it just, you notice you flipped. But so you're right. Like, so that's why I would always try to be clear to say either financial capital or capital goods, to not confuse the two, because if you just say capital, you're not sure what the person means.
I think you were ahead of us. Yeah.
Oh, well,
Yeah, man. But now we're all on the same page.
Yeah, we're all on the same page. So, I mean, I didn't make, I could see in your book you were doing things. So I'm looking at the clock here, and I do want to do one, give you a chance to just speak. It seemed like a big theme in the book was this EVA, economic value added.
Yeah.
So can you maybe explain what that is, and then what's the relationship between what you and Nicolás are doing?
Yes. Okay. So that's exactly where I was going. Okay. So Nicolás, at sometime in his past, worked in a bank, and he worked with financial concepts. He worked with financial consultants, and he became aware of this idea, economic value added. Joel Stern, I knew his name because way back, ancient history, he was a consultant in South Africa. He made a name for himself there. I think came back to America, and he put together this consulting firm, and they used this framework called economic value added. And I should add also that Nicolás's father, I'm really pleased to be involved in the translation with Nicolás in the translation of his work. He had the initial spark sort of the idea of capital value that I think pushed Nicolás to find out this idea of duration, and also sort of where EVA fits in. EVA and MVA. So, and I'm referring to one Nicolás Cachanosky, Nicolás' late father. He unfortunately all his work was in Spanish, But Nicolás has translated it, and I've been involved in editing some of it. And eventually, I think we'll bring out a book of his essays, which are fantastic. So EVA, what it does is it says, okay, so you have the capital value of the company, which you get in one way or another by using what I call the universal arithmetic of present value. You basically have to decide what is the business going to produce, and in a sense, how successful do you think it's going to be, and then you put a number on it, and you use these capital flows over time, these earnings flows over time to characterize what the business looks like. And sometimes you get there's a lot of judgment in deciding in terms of the flow assigned to a particular period, how much of that is revenue and how much of that is cost and how much of that is investment. And that's really not a trivial thing. For example, Amazon, how many years did they sort of proceed without ever really declaring accounting profits? And how did they survive without making profits? And if you sort of look back on it, you see what probably is going on there is in terms of a cash flow coming in that they could have used to pay out dividends or calculate profits on, they're reinvesting back in the company as part of some of it is part of operating costs, which is, if you like, true costs. There's an opportunity cost for that they could have used it for something else, but they absolutely need to use it to keep the business going. And then there's judgment calls that basically they have expanded facilities, built new warehouses, advertised, all of that. What the EVA tries to do is to break up that cash flow, sometimes called the free cash flow, into a portion that is the true cost of capital, true in quotes, and a portion that is earnings, and where earnings will include future earnings. So investments, earnings that you take for now and future earnings. So it kind of breaks out. Again, it would be easier to show if I was able to give you the formulas, but basically it's making a judgment as to sort of how much it's costing you to invest this capital in your own business compared to if you had to borrow it, how much would you have to pay? That's the opportunity cost for you. So the economic value added then is the judgment as to sort of not just the revenue that you've earned in that period, but how much value have you actually added to that business. And if you sum that up, you get what they call the market value added. So I mean, one has to emphasize, of course, value is always subjective. And so there's judgment involved. But if you believe that the consultants have a way to advise you on that, ultimately the entrepreneur is going to make the decision as to how to present this. But Nicolás brought that to the table, and we were able to integrate that profitably or productively with the idea of duration as well. How much economic value added is going to be earned in any particular period.
Okay, well, great. So it's, again, I just wanted to just stress that because showing these terms that I know people in the financial sector will be familiar with, and then it's sort of linking up with your more theoretical, economic theory approach, that the two link. And it's, again, I think it flows both ways, that the standard Austrians who are just reading the classics can certainly benefit from looking at some of the finance literature, but then going the other way too. In the finance sector, like I said, when I got in, I realized like they don't know why interest rates move or something. They just assume, and it's good. Like you want to be robust and be hedged and whatever, no matter what happens. But it's
right.
Like I think you guys could say a little bit more than what you're saying here with some of these results. They're pretty tepid because they're just they don't know what drives interest rates.
Yeah, that's and Nicolás did do some work along the way in identifying so-called mainstream economists who were really using Austrian reasoning without realizing it. But more needs to be done. I agree.
Definitely. Well, I think that's a good spot for us to wrap up. So, folks, the book we've been discussing is Capital and Finance with a subtitle of Theory and History. It's out of Routledge International Studies in Money and Banking. So, again, especially if you're a grad student or a young PhD in the Austrian tradition looking for stuff to read, I point you to this definitely. My guest has been Peter Lewin. Peter, thanks so much for your time.
Been a pleasure, Robert.
Thank you, everyone, for tuning in, and we'll see you next time.
Check back next week for a new episode of the Human Action Podcast. In the meantime, you can find more content like this on Mises.org.